I'm 99 years old, and I've been investing for over 75 years. I've seen every kind of investment, every kind of bubble, every kind of crash. And people are always surprised when I tell them that despite all the wealth I've accumulated, despite all the real estate opportunities I've had access to, I still prefer stocks over real estate. And today, I'm going to explain exactly why that is. Now, before you think I'm completely against real estate, let me be clear. I'm not saying real estate is a bad investment. Warren and I have owned real estate. Berkshire Hathaway owns real estate. I understand the appeal. But when people ask me where they should put their money, when they ask me how to build lasting wealth, I tell them the same thing every time. For most people, a carefully selected portfolio of stocks will beat real estate over the long term. And I'm going to explain exactly why. You see, most people have real estate investing completely backwards. They think it's safer than stocks. They think it's more tangible, more real. They like the idea of owning something physical that they can see and touch. But this emotional comfort is exactly what makes them overlook the significant disadvantages that real estate has compared to stocks. And these disadvantages compound over time in ways that most investors never calculate properly. I've spent my entire life studying what makes certain investments superior to others. I've analyzed thousands of businesses, studied hundreds of real estate deals, and watched countless investors make the same mistakes over and over again. And what I've learned is that the best investments share certain characteristics. They're easy to buy and sell. They require minimal ongoing effort. They can compound without interference. And most importantly, they allow you to own pieces of exceptional businesses run by exceptional people. Stocks, when chosen correctly, have all of these characteristics. Real estate, with very few exceptions, has none of them. And over a lifetime of investing, these differences compound into enormous gaps in wealth accumulation. Let me show you exactly what I mean. The first and most important advantage that stocks have over real estate is what I call frictionless compounding. This is the ability for your investment to grow without you having to do anything, without transaction costs eating into your returns, and without your capital being trapped in illiquid assets. Let me explain this with a specific example. Suppose you buy shares in a wonderful business like Coca-Cola back in 1988, which is when Berkshire made our major investment. You pay your brokerage commission, which even back then was quite small, and now you own a piece of a business that operates in over 200 countries. Coca-Cola's management goes to work every single day, making decisions, improving operations, expanding into new markets, and building the brand. And you do absolutely nothing. Every quarter, Coca-Cola sends you a dividend. You can reinvest that dividend to buy more shares, again with minimal transaction costs. The company reinvests its retained earnings at high rates of return, which increases the value of your ownership stake. And all of this happens without you lifting a finger. You don't have to find tenants. You don't have to fix toilets. You don't have to deal with property managers. You don't have to worry about property taxes or insurance or maintenance. This is what I mean by frictionless compounding. Your capital is working for you 24 hours a day, 7 days a week, with minimal interference and minimal costs. Over decades, this makes an enormous difference. Now compare this to real estate. Suppose instead of buying Coca-Cola stock, you buy a rental property. First, you have to find the property, which takes time and effort. Then you have to negotiate the purchase, which involves real estate agents who take 5 to 6% of the purchase price. Then you have closing costs, title insurance, inspections, all of which add another few percent. Now you own the property, but your work is just beginning. You need to find tenants, which might require advertising, showing the property multiple times, running credit checks. You need to manage the property or pay someone to manage it for you, which typically costs 8 to 12% of the rental income. You need to handle maintenance and repairs. A roof might need replacing, which costs tens of thousands of dollars. A tenant might damage the property. An air conditioning unit might break. All of this takes time, money, and energy. And every dollar you spend on these expenses is a dollar that's not compounding. Every hour you spend managing the property is an hour you're not spending on more productive activities. The friction is constant and substantial, but it gets worse. Suppose after 10 years you want to sell the property and deploy your capital into a better opportunity. Now you pay another 5 to 6% in real estate commissions plus closing costs. If you've made a profit, which you hopefully have, you owe capital gains taxes. And the entire process of selling takes months, during which time your capital is essentially frozen. Compare this to selling a stock. I can sell my Coca-Cola shares in seconds. The transaction cost is minimal, often just a few dollars, regardless of the size of the transaction. I can immediately redeploy that capital into another opportunity. The friction is negligible. Over a lifetime of investing, this difference in friction compounds into an enormous advantage for stocks. Every percentage point that you pay in transaction costs, every dollar that you spend on maintenance, every hour that you waste on property management, these are all costs that reduce your compounding. And in investing, as in life, it's not what you make that matters, it's what you keep. The second major advantage that stocks have over real estate is what I call the quality selection advantage. With stocks, you can choose to own pieces of the very best businesses in the world, run by the very best managers in the world. With real estate, you're typically stuck with whatever properties are available in your local market, and you're the manager, whether you're qualified or not. Think about what this means practically. When I buy stock in a company, I'm essentially hiring the management team to work for me. If I buy Apple stock, I'm hiring Tim Cook and his team. If I buy Costco stock, I'm hiring their exceptional management. These are people who have proven track records, who have built phenomenal businesses, who wake up every morning thinking about how to create more value. And here's the beautiful part. These managers work for thousands or millions of shareholders simultaneously. Their expertise and effort are being deployed on behalf of all of us at the same time. I get the benefit of Tim Cook's leadership ability without having to pay his entire salary myself. I get the benefit of Costco's operational excellence without having to build that system myself. Now compare this to real estate investing. When you buy a rental property, you are the manager, or you hire a property manager who is typically not going to have anything close to the skill level of a Fortune 500 CEO. You're not getting access to exceptional talent. You're getting access to whoever is available in your local market at a price you can afford to pay. This difference in management quality compounds enormously over time. A great manager at a great company can compound capital at 20 or 25% annually for decades. A mediocre property manager is going to give you mediocre results, probably 8 to 12% annually if you're lucky. And that's before accounting for all the friction costs I mentioned earlier. But the quality selection advantage goes even deeper than management. With stocks, you can choose to invest only in businesses with tremendous competitive advantages. Businesses with strong brands, high switching costs, network effects, or cost advantages that allow them to earn high returns on invested capital year after year. Coca-Cola has a brand that took over a century to build. Apple has an ecosystem that creates enormous switching costs. Visa has a network that becomes more valuable as more people use it. These competitive advantages, what Warren calls moats, are incredibly valuable and incredibly difficult to replicate. Real estate rarely has anything comparable. Yes, location matters, and a property in a great location is better than a property in a mediocre location. But the competitive advantage of location is nowhere near as strong or as durable as the competitive advantages of great businesses. A new apartment building can be constructed near your rental property, increasing competition. Neighborhood dynamics can change. Crime rates can rise. Schools can deteriorate. Your moat in real estate is shallow and vulnerable. The third major advantage of stocks is liquidity and portfolio construction. This is an advantage that most investors dramatically underestimate because they don't think about how their entire portfolio needs to be constructed over a lifetime. When you own stocks, you have complete liquidity. If you need cash for an emergency, you can sell shares immediately. If you identify a better opportunity, you can reallocate capital in minutes. If your life circumstances change and you need to adjust your portfolio, you can do so easily. This liquidity has enormous value that compounds over time. It means you're never stuck in a bad investment. It means you can always optimize your portfolio. It means you can respond to opportunities quickly when they arise. Real estate is the opposite. It's one of the most illiquid assets you can own. If you need to sell quickly, you'll probably have to accept a substantial discount. If you want to reallocate capital from one property to another, it takes months and costs thousands or tens of thousands of dollars in transaction fees. You're essentially locked into each investment for years. This illiquidity has hidden costs that most real estate investors never properly calculate. How many great investment opportunities have you missed because your capital was tied up in real estate? How many times have you held on to a mediocre property longer than you should have because the transaction costs of selling were too high? These opportunity costs compound over decades. But liquidity isn't just about being able to sell quickly. It's also about portfolio construction. With stocks, I can easily own a diversified portfolio of 20 or 30 exceptional businesses across different industries and geographies. This diversification reduces my risk without reducing my returns, because I'm still owning only the highest quality businesses. With real estate, achieving this level of diversification is essentially impossible for most investors. You might own 2 or 3 or 5 properties if you're quite wealthy, but they're probably all in the same geographic area, subject to the same local economic conditions, the same local regulations, the same local real estate market dynamics. You have concentration risk that you can't easily eliminate. And here's something that most real estate investors never consider. When you own real estate, you're making a leveraged bet on a single local economy. If the local economy does well, you do well. If it doesn't, you don't. Your fate is tied to factors completely outside your control. Local zoning decisions, local tax policies, local economic development, local demographic trends. When I own a diversified portfolio of stocks in great companies, I'm not making a bet on any single economy. I own businesses that operate globally, that have multiple revenue streams, that can adapt to changing conditions. My risk is much lower, but my expected returns are just as high or higher. The fourth advantage is scalability and the ability to invest in truly exceptional opportunities. This is perhaps the least understood but most important advantage of stocks over real estate. When you invest in stocks, you can own pieces of businesses that are doing things you could never do yourself. You can own part of a company that's discovering life-saving drugs. You can own part of a company that's revolutionizing how people communicate. You can own part of a company that's building the infrastructure of the internet. These businesses create enormous value, and as a shareholder, you participate in that value creation. Real estate, by its nature, is commodified. One apartment building is largely like another apartment building. One office building is largely like another office building. Yes, location matters and quality matters, but the differences are marginal. Real estate doesn't create new value in the same way that a great business creates new value. Let me give you a concrete example. Berkshire Hathaway bought See's Candies in 1972 for $25 million. At the time, See's was generating about $4 million in pre-tax earnings. Since then, Seas has paid Berkshire nearly $2 billion in dividends while requiring minimal reinvestment. The business has grown not because we built more candy factories, but because the brand became more valuable, because management improved operations, because distribution expanded. Could you achieve that kind of return with real estate? Not likely. A property you buy today will generate rental income, and hopefully that income will grow with inflation or slightly faster. But you're not going to see your cash flow multiply by 50 times while requiring minimal additional investment. That's just not how real estate works. This scalability advantage extends to how much capital you can deploy. If I have $10 million to invest, I can easily put that into stocks in exceptional businesses. If I have $100 million, I can still do that. If I have $1 billion, I can still do that, though I have fewer options because I'm limited to larger companies. But with real estate, scaling is much harder. Each property requires individual attention. Each property has its own management challenges. Each property ties up capital in an illiquid asset. Trying to build and manage a portfolio of 20 or 30 or 50 properties becomes a full-time job and probably requires hiring a significant staff. You've essentially started a business with all the headaches that entails. The fifth advantage is tax efficiency, though this one requires some nuance. Real estate investors often claim that real estate has better tax treatment than stocks because of depreciation deductions. And it's true that depreciation can shelter rental income from taxation, at least temporarily. But this advantage is overstated and comes with significant drawbacks. First, depreciation is merely a timing benefit. You get to defer taxes. But when you sell the property, you have to recapture that depreciation and pay taxes on it. So you haven't eliminated the tax, you've just delayed it. And in the meantime, you've had all the friction and illiquidity I mentioned earlier. Second, the depreciation benefit only applies to rental properties that you're actively managing. It doesn't apply to REITs or other passive real estate investments. So to get this tax benefit, you have to take on all the work and headaches of being a landlord. Third, and most importantly, stocks held for the long term have better tax treatment than most people realize. If you buy stocks in wonderful businesses and hold them for decades, you only pay taxes when you sell. The compounding happens tax-free. This is an enormous advantage that people underestimate. Let me give you an example with real numbers. Berkshire bought Coca-Cola stock in 1988 for $1.3 billion. Today, that stake is worth roughly $25 billion. We've received billions in dividends over the years on which we paid taxes, but the $23 billion or so of capital gains, we haven't paid a penny of tax on that because we haven't sold. That capital has been compounding tax-free for over 35 years. Compare this to real estate. You have to pay property taxes every single year on the assessed value. These taxes come out of your cash flow, reducing your compounding. So even with the depreciation benefit, the tax situation for stocks held long term is often better, especially when you factor in the elimination of all the friction costs. Now, there is one legitimate tax advantage that real estate has, which is the 1031 exchange. This allows you to sell one property and buy another of equal or greater value while deferring capital gains taxes. This is a genuine benefit. But again, to take advantage of it, you have to go through the entire process of selling one property and buying another, with all the transaction costs and time that entails. And you're still stuck in real estate with all its disadvantages. The sixth advantage is something I call asymmetric upside. With stocks, you have limited downside, but theoretically unlimited upside. The worst that can happen is your investment goes to zero, but the best that can happen has no limit. With real estate, both your upside and downside are more constrained. Let me explain what I mean. When Berkshire bought See's Candies, we thought we were buying a good business at a fair price. We expected decent returns. But what actually happened was that See's turned out to be even better than we thought. The brand was more powerful. The pricing power was stronger. The capital efficiency was higher. Our return ended up being far higher than we initially expected. This kind of asymmetric outcome happens with stocks in great businesses. You buy something you think is good, and sometimes it turns out to be extraordinary. Amazon shareholders in the late 1990s probably expected good returns. They didn't expect returns of 100 or 200 times their money. But that's what happened. Apple shareholders in 2003 probably expected a decent investment. They didn't expect the iPhone revolution, but they got it. With real estate, you rarely get these kinds of surprises to the upside. You buy a property for a certain price, expecting certain rental income and certain appreciation. Sometimes you do a bit better than expected, but you're not going to see 10 times or 50 times or 100 times your money. The nature of real estate constrains the upside. And here's the thing. In investing, you don't need to hit home runs often. You just need to avoid strikeouts and get a few home runs over a lifetime. Stocks give you the ability to hit those home runs. Real estate rarely does. The seventh advantage is what I call cognitive leverage. This is the idea that learning about businesses makes you smarter in ways that compound throughout your life, whereas learning about real estate doesn't provide the same benefits. When I study a business, I'm learning about competitive dynamics, about what makes customers choose one product over another, about management quality, about capital allocation, about technological change, about industry economics. This knowledge is transferable. What I learned studying retail businesses helps me understand consumer behavior, which helps me analyze other consumer businesses. What I learned studying banks helps me understand credit cycles and risk management. This knowledge accumulates and compounds. After decades of studying businesses, I've developed mental models that allow me to quickly understand new situations, identify what matters and what doesn't, and make better decisions, not just about investing, but about life in general. Learning about real estate doesn't provide the same cognitive benefits. Yes, you learn about property values and rental markets and financing, but this knowledge is narrower and less transferable. It doesn't teach you about human nature or competitive dynamics or innovation in the same way that studying businesses does. Warren and I have both said that the best investment you can make is in yourself, in your own knowledge and abilities. Spending your time studying great businesses is a much better investment in yourself than spending your time managing rental properties. Now, let me address some of the common arguments that real estate investors make, because I want to be fair and thorough. The first argument is that real estate provides leverage, and leverage amplifies returns. This is true. You can buy a property with 20 or 30% down and borrow the rest. If the property appreciates, your return on your actual capital invested is amplified by the leverage. But here's what people miss. Leverage is a double-edged sword. It amplifies gains, but also amplifies losses. And more importantly, leverage adds fragility. If you own stocks with no debt, you can ride out any downturn, no matter how severe or how long it lasts. If you own real estate with significant debt, you have to keep making mortgage payments every month, regardless of whether you have tenants or what the property is worth. During the 2008 financial crisis, many real estate investors who were using leverage got completely wiped out. Their properties declined in value, they couldn't make their mortgage payments, and they lost everything. Meanwhile, stock investors who owned shares in great businesses with no margin debt were able to hold through the downturn and eventually recover all their losses and more. The second argument is that real estate provides inflation protection. This is partially true. Property values and rents tend to rise with inflation over long periods, But great businesses also provide inflation protection, often better than real estate. Think about a business like Coca-Cola or Visa or Costco. When inflation happens, these businesses can generally raise their prices to offset their higher costs. In fact, businesses with pricing power often do better during inflationary periods because they can raise prices faster than their costs rise. Real estate, by contrast, doesn't automatically adjust for inflation. If you have tenants on long-term leases, you can't raise rents until the lease expires. If your costs rise due to inflation, property taxes, insurance, maintenance costs, those costs come out of your cash flow immediately. And if inflation is accompanied by rising interest rates, property values often fall even as inflation is rising. The third argument is that real estate provides diversification from stocks. This is true to some extent. Real estate doesn't always move in the same direction as stocks. But the diversification benefit is smaller than people think because both stocks and real estate are ultimately driven by the same underlying economic factors. When the economy is doing well, both stocks and real estate tend to do well. When the economy is doing poorly, both tend to do poorly. The correlation isn't perfect, but it's high enough that real estate doesn't provide as much diversification benefit as people think. And here's the key point. If you want diversification, you can get it within stocks by owning businesses in different industries, different geographies, with different economic characteristics. You don't need to go into real estate to achieve diversification. The fourth argument is that real estate is more tangible and easier to understand than stocks. You can see the property, walk through it, touch it. This makes people feel more comfortable. But this emotional comfort is actually a disadvantage disguised as an advantage. The tangibility of real estate creates an illusion of control and an illusion of understanding. People think they understand real estate because they can see it, but they don't understand the economics nearly as well as they think they do. They don't properly account for all the costs. They don't properly calculate their true returns. They don't understand the risks they're taking. Stocks, by contrast, are abstract. You own a piece of a business, but you can't touch it. This makes people uncomfortable. But if you do the work to actually understand the business, you often have better insight into the true economics than you do with real estate. And the abstraction prevents you from confusing tangibility with understanding. Now, let me be clear about something. I'm not saying that everyone should avoid real estate completely. There are some situations where real estate makes sense. If you're buying a home to live in, that's different from investing. You're getting utility from living in the home, not just investment returns. The economics are different. If you have specialized knowledge or skills in real estate, if you're a professional developer or property manager, you might be able to overcome the disadvantages I've outlined if you can buy properties at below market prices, if you can add value through renovations or better management, if you have access to deals that ordinary investors don't have access to. You might be able to earn returns that justify the extra work and friction. But for most people, for ordinary investors who are trying to build wealth over a lifetime, a carefully selected portfolio of stocks in wonderful businesses will produce better results with less work, less stress, and less risk than a portfolio of rental properties. Let me give you my practical advice for how to implement this approach. First, study businesses until you understand what makes them great or mediocre. Read annual reports. Study competitive dynamics. Think about what gives a business pricing power, what creates customer loyalty, what allows a business to earn high returns on capital. Second, identify a handful of truly exceptional businesses that you can understand and that are trading at reasonable prices. You don't need dozens. 10 or 15 wonderful businesses is enough to build enormous wealth over a lifetime. Third, buy those businesses and hold them. Don't trade in and out. Don't try to time the market. Just own pieces of wonderful businesses and let the management teams do their work while your capital compounds. Fourth, live below your means so you can continue adding to your investments over time. The combination of compounding returns and adding new capital regularly is incredibly powerful. Fifth, be patient. Compounding takes time to work its magic. You're not going to get rich overnight. But over decades, if you own the right businesses, the results will be extraordinary. This is exactly what Warren and I did. We identified wonderful businesses, we bought them at reasonable prices, and we held them for decades. We didn't waste time managing rental properties. We didn't spend our energy dealing with tenants and toilets. We spent our time thinking about businesses, and we let those businesses compound with minimal interference. The results speak for themselves. Berkshire Hathaway has compounded at roughly 20% annually for almost 60 years. No real estate investor in the world has achieved results anything close to that over such a long period. And we did it while spending our time on intellectually interesting work, studying businesses and learning about the world, rather than on the mundane work of property management. I'm 99 years old now. I've had a long time to think about investing and what works and what doesn't. And I can tell you with complete confidence that for most people, stocks in wonderful businesses are a far better path to building wealth than real estate. The compounding is more efficient. The businesses are higher quality. The liquidity is better. The scalability is greater. The cognitive benefits are larger. Real estate has its place. It's a fine asset class. But if you're trying to build lasting wealth with minimal effort and maximum efficiency, stocks are the answer. Study businesses, buy wonderful ones at fair prices, hold them forever. That's the formula. It worked for Warren and me, and it will work for you.